Okay, we're getting started right now. Got my notes ready. Camera one. All right. Hey, thanks so much for joining me. I'm Mitch Goldberg. If we haven't met yet, I'm a financial advisor with the wealth management firm Client First Strategy. This is my live stream. I call it Be the Boss of Your Money. It's about taking control of your money. It's about sharing with you lessons, mistakes, how I've overcome financial challenges, how my clients have overcome financial challenges. I learned by the mistakes that they've made and I've helped them get through them. I've been a financial advisor for 32 years. So I've helped people through all kinds of situations and I've learned so much over the decades and I just share it all right here. Uh, the idea is to help you take control of your money so you could be better with your money so you can make potentially better financial decisions, which is really something that's important to all of us, especially as we get older. And if you're watching this show and you are, I don't know how I would define older. I say if you're my age, 50 plus, this could reinforce a lot of things, teach you new tricks. If you're below my age, so under 50, you will learn a lot here, just so much. I've seen for everyone, I've seen so many clients overcome so many challenges. I've seen clients make mistakes and then overcome the challenges from the ramifications of their mistakes. And it helps. I mean, that's called experience, right? Now, while you're watching this live stream, whether in the whether now live or during the replay, if you have any questions, hit me up in the comments. I love hearing from you. It's the best part of doing this. And while you're watching, if you would be so kind, give it a thumbs up, a heart, a wow, a celebrate, depending on which reaction you have available to you, depending on which social media platform you're watching from. We broadcast to YouTube, LinkedIn, Facebook, Twitter. We post all of our highlights on those social media platforms as well as Instagram. So I'll put my handles up here. All right. So these are the places where you could connect with me and follow along, say hi. I'd love to interact with you. So what we're going to do is this: we're going to talk more about, um, you know, we're going to talk more about what to expect for the second half and how bad the first half of the year was. But the first half of the year does have one more day to go. Unless something really dramatic happens, this was a pretty bad quarter by any stretch. It's the worst quarter for the Nasdaq and the Dow since 2020, and those are pretty bad. But it's the worst. It's the worst first half. The worst first half of a year. Let me go back. It's the worst first half of a year since 2020 for the Dow and the Nasdaq, but it's the worst first half of the year for the S&P 500 since 1970. Okay, so basically, if you're you know under 52 years old, you've never seen a first half of the year market like this. And if you're 52, you've probably only been investing for the last 20 or 30 years at most. So you've never seen this before. Okay. Now, I've been in the industry for 32 years since 1990, and I have never seen a worse first half of the year in the S&P 500 than what we're witnessing now. And again, unless something dramatic changes, we'll be saying the same thing tomorrow, which is really the last day of the first half of the year. So we're going to go through a little thing here. We're going to talk about which stocks did worse. And tomorrow I want to talk about signs of a bottom and what we could or what we should look for to see signs that we could get through the spare market pretty soon. We might not get through it pretty soon. The spare market could drag on for a long time. And I can give you the counter reasons for both, why the market should go lower, why it should go higher. But in a bear market, the reasons for the market going lower always prevail. Just like in a bull market, the reasons to go higher prevail. Just like, when you're having a bull market, no matter how bad the news is, it's just interpreted as good news and the market goes up. It's the opposite now. So what we're going to do first is roll a quick intro. We're going to have a good show and we'll be done in about, 14, 15 minutes. So give it a moment, get your questions ready, hit me up in the comments or just say hi, or words of wisdom, words of encouragement are always appreciated as well. Here we go with the intro. Okay, thanks so much for joining me. I'm Mitch Goldberg. We are just getting started. So you haven't missed anything yet. We're going to get into the heart of the matter. Today was a day in the stock market that was more like meandering, nothing much going on. Dow up a tiny bit. The other two averages, the S&P, Nasdaq off a little bit. By the way, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. And just have to say, diversification. That's a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. Okay, there are the disclaimers that always have to somehow work into the conversation. So, what do you guys think of today? We had the big rally last week. We were off a drop on Monday, and I said that doesn't tell us anything. The fact that we're up over 800 points, almost 900 on the Dow last Friday. So, the following Monday, off a drop, big deal. Yesterday, the Dow was off 400 points or so, 400, almost 500 points. Dow was down 490 points yesterday. So, definitely a down day. But things held up, fairly well today. All right. So, there are so many schools of thought here. Are we in a recession? Well, that means the Federal Reserve should be near its completion then of its raising of interest rates. Because if we're in a recession, you would expect prices and inflation to go down. Or we could just say prices or just inflation. I don't think I have to say prices and inflation, but I'm on the fly here. I mean, have you ever had a day like when you just had all your shit together, everything fell in line, scheduling was perfect, all the calls were at the right time, all the checks coming in, checks going in, everything was just perfect and everything just went so smooth? You ever have a day like that? Yeah. Yeah, today was not one of those days for me, but nonetheless, it was still a pretty good day. Okay. So, wow, did lose track of my thoughts already. Yes, my ADD is kicking in so hard right now. Yeah, so what a day. So today markets were basically flat, and I feel like my sense is there's an equilibrium right now. Investors don't want to buy, they don't want to sell. We've got the Independence Day holiday coming up this weekend. Markets are closed next Monday. So there's really not a lot going on. Tomorrow is Thursday, and I expect Thursday and Friday to be super quiet. Like already, I could tell you the parking lot in my office building, and I'm in a typical 4-story suburban office building. The parking lot is 75% empty, or you could say it's 1/4 full for you parking optimists out there. But it's already like you're already starting to see tumbleweeds up and down, blowing around the parking lot. There's just not a lot going on, but there are things in the market going on. So we already have our first commenter, and it is Jaybird. Market is boring everyone into complacency. Well, yeah. Well, listen, I think the market investors have been complacent for a long time, and now they're paying the price for it now. But I know what you mean, and that's why we always say never short a dull market, right? Because you never know what happens. But are we in a recession? Are we not? I think we are, but whether or not the rest of the market participants believe we are or not, that's their business, and I really don't have to worry about other people's opinions if we are or not. But I do have to worry about what my fellow investors do. So if we're in a bear market, that could if we're in a bear market, that could actually be bullish now for stocks because it would mean the Fed is starting to get to the end of its quantitative tightening, getting to the end of its interest rate increases. We need another 2 or 3 months of inflation reports to see if inflation is moderating, if the growth rate of inflation is moderating. Fed wants to get down to 2% inflation rate. We're like 8. I mean, that's a long, long way to go to get down to 2% inflation rate right now. We'll see. The Fed says they're convinced to keep going, to keep raising rates until inflation comes down. But a recession would bring down rates. And I know it sounds weird, and I feel like so many of us feel like we're in a recession. We have so much economic anxiety right now, so much anxiety about the economy, because we feel like something's coming, something bad is about to happen. And there are little things that have been pretty bad that have happened. Nothing that's killed the market yet. Now, when I say that, just keep in mind the S&P is off about 20% from its peak. Technically, that's the definition of a bear market when an index drops 20% or more from its peak. But I think that we need to have the expectation of bear markets built into our psyche, our psyche, into our investment portfolios. You know that, right? It's we have to know that these hit once in a while, and there's really not much we could do about it, and it's really hard to time exactly when they happen. And we're in it now. Maybe the S&P goes down another 20%, so it's down 40% from its all-time high. Maybe we just we're so addicted to quantitative easing and other easy Fed policies that once they're taken away, investors finally realize that nobody's going to want to own stocks for a couple of years, and stocks would go down a lot lower, or maybe they just go a lot higher. It's really tough to say, and this is why you just have to invest for yourself. You have to play your own game. Okay. What we do here, hey, Tina is out there. What's up, TLM? TLM in the house. Peace. All right. So what we need to make sure we do is play our own game, march to the beat of our own drum. If my retirement is 20 years away, my views of up and down markets are very different than the next person whose retirement might be 30 or 40 years away. And it could be different than someone whose retirement is 5 years away. I would say if once you have 20 years out, you're really a long-term investor. And the stock market has been a place to beat inflation, to earn a return above and beyond inflation. But that's only after you average out returns over, rolling 10-year periods, not after a year or two. All right. So we're going to survey some damage. Part of the survey of damage is to make me feel good because I've sidestepped almost all of this damage. Part of it doesn't make me feel so good because, some of the stocks I have are hit, although I don't have the SPACs. I don't have, I don't have Hulu and Peloton. Those are not mine. They're not my stocks. But I have stocks like Disney and Meta, which is Facebook, that are still down 50% or so from their all-time highs. So don't think that just because you avoided the most speculative areas of the market that you sidestep the pain here in the bear market. But I feel that the stocks I have will get through it and have a reasonable chance of recovering. Whereas a lot of these SPAC stocks or the meme stocks or the stay-at-home pandemic stocks, I don't think I personally think most of these stocks are never going to go back to where they were, not even close. And I think you just probably pissed away a lot of money if you were, chasing these things and you thought you had to be in them. And then when they started to go down 20, 30%, you saw somebody in TV say, I think this is a buy. It's down 30%. You should buy it. And then the stock drops like another 80%, right? Bed Bath and Beyond, is a stock that's gotten absolutely clobbered recently. So I just every day I look at these stocks and I'm like, I just can't believe the losses that people must be sitting on. But I don't think the market goes up until you see investors realize these losses. That's what we're waiting for. All right, we're waiting for investors to realize the losses and finally give up. The capitulation stage. I don't really know if there's a way to measure. Well, the way to measure capitulation for a benchmark like an index like the S&P 500 is a plunge down and a spike up in volume. There's lots of ways you could look at a chart for that. Okay, but you see the spike down in the level of the S&P, and you see a spike up, a substantial spike up in the volume amount of shares traded, and that would generally give you an indication of a turning point in the stock market. I don't think we're there yet, but it's it's dribs and drabs. It's just a drop at a time. Maybe stocks have bottomed out and they're starting to go up, and we're too dumb to realize that this is the best opportunity to buy stocks in years. Or maybe we're dumb to buy any stocks now because it's blatantly obvious of why the reasons are that the market should go lower. So are we in a recession? Are we heading into a recession? Does it change the calculus does it change the calculus for the Federal Reserve? These are all the things that we take a look at, and these are all the things that I share with you and my thoughts. And my thought process is most of you, including myself, we don't really have to do anything. We don't have to change our investments. We don't have to buy this and sell that. Just sit with what you have and wait it out. And if you're older, like 55 plus, hopefully you've moved some of your money to cash and short-term bonds, cash equivalents and short-term bonds, so that you have money on the sidelines, so you don't have to sell into a down market. If you're worried that you have to sell your stocks in a down market, well, you did it wrong. I'm sorry to tell you, you've been doing it wrong, and we need to correct that going forward. It's not too late to correct it for most people. Let's take a look at the boards. Okay, first I have to just shut my email down so you guys don't get a view of my ugly email. And we'll take a look at this. I'm just fixing up my screens right now. I'm going to make the screens a little bit larger so you can see them. Okay, and I'm going to move my screen to the middle. These are like some of the behind the scenes stuff that you might not necessarily see. We're going to get rid of the emojis. Get out of here, guys. Okay, and we're going to go here to the screen. Okay. All right, we're going to look at the stock market first. U.S. stocks. Okay, so the Dow is up 82 points after being down almost 500 yesterday, flattish the day before. So no big deal, up 0.25%. NASDAQ down 0.03%. S&P barely down. So it was just a really flat day on the major averages. Gold was off a drop. Energy was off a good amount. So that's that. The VIX came down. It's still under 30 at 28. If the longer it stays below 28, the more optimistic we could become. Let's look at bonds, the yield curve. Interest rates were pretty much lower across the board. Just a general malaise in the stock market, getting investors to purchase bonds across the board. So bond yields went down ever so slightly. It doesn't really tell me anything. I don't see any signal in that. That yields came down a little tiny bit in the yield curve, the treasury bonds. Okay. I want to show you this. This is Ethereum. Ethereum hit a 52-week, well, it says 52-week high today, but it's a 52-week low. They're wrong about that. Okay. But anyway, Ethereum, I don't know if this will give me year to date, but Ethereum was at one point about 4,700. Okay. And now it's 1,100. So it's lost over 80% of its value. And Ethereum was a crypto. It is a crypto. It's a crypto that was at one time thought of the winner. Like this one would be the one you have to buy. Well, I don't like Bitcoin, but I like what Ethereum is doing. So people had to pick something. And it just goes to show you, I've talked about this 100 times, maybe more. We don't really know. We don't really know which is going to be the winning crypto. In fact, the winning crypto one day might not even be on your radar. It might not even be invented yet. So it's kind of like the internet stocks. Like, you could have bought any portfolio of internet stocks in the year 2000 and you would have lost your ass on those because it turned out you didn't have the winners in them. I mean, some of them may have had a tiny bit of Amazon, but not enough to really make it a winner. Certainly Apple was not considered a internet player back in 2000. By the way, the iPhone turned 15 years old today. Just a little tidbit of useless information. And now let's take a look at a couple of stocks. I want to show you these individual stocks because they tell a story that I'm not liking too much. So here we go. Okay. I want to look at two stocks. Restoration Hardware, RH. Restoration Hardware, this is aftermarket trading. They lowered their guidance, and the stock is down $12.42, down over 5% in the aftermarket trading after being flat on the day. Restoration Hardware, RH, was $744. Now it's $224. So it's like a $74 stock going to $22. No matter how you slice it, that is a massive loss, losing 2/3 of its value. And Nike 179 down to 103. That was like 112 on 113 on Monday. They came out with earnings that weren't so great, not a great forecast, and the stock went all the way down to a little over $100 a share. The reason I'm pointing out RH and Nike is because these are really catering to a higher end consumer. I'm not saying you have to be rich to buy a pair of Nike sneakers, but Nike sneakers is definitely considered a premium product. So how much of their product that's considered premium is being sold at a discount at discount shoe stores like DSW and other outlets? But when Nike doesn't do well, that really tells you that consumers are worried about the economy. And when Restoration Hardware lowers their forecast, where that's a really high-end company, that also tells you that consumers are worried and pulling back, keeping their wallets shut. So I think these are leading indicators of what's to come. Okay, and then I want to take a look at the FANG M stock. So that's Apple, Amazon, Google, Meta, which used to be called Facebook, Microsoft, Netflix, and NVIDIA. So there are 6 stocks I just named. I'll show you these. Okay. Apple, Amazon, Google, Meta, Microsoft, Netflix, and NVIDIA. So out of these 6 stocks, these are like the 6 biggest publicly traded companies in the S&P 500. They're the dominators, and when these companies move, they push the rest of the market with them. But they have gotten absolutely clobbered this year. And the biggest winner year to date of this particular cohort of stocks is Apple, which is down 21%. Imagine you're a winner by only being down 21% year to date. Who is after Apple? Google and Microsoft are both down about 23%. So right behind Apple as far as the winners go in this group. Again, winning by losing the least amount of money. After that, Amazon is down 35% year to date. NVIDIA down 47% year to date. Meta, which is Facebook, down 51%. And Netflix is down a whopping 70% on the year. So when we look at this chart on Netflix was like a can't miss stock for so long. It's like a $70 stock. Let me go over here. It's like a $70 stock going down to 17. I mean, just an obliteration of wealth. Okay, but let's take a look at how this one did. Let's just do year to date. That is one ugly chart, ladies and gentlemen. That is a really ugly chart. All right. So we're just surveying the damage and letting you know that, hey, if you didn't have a great first half of the year of 2022, don't kick yourself. I mean, it's just, when you own stocks, you typically own the biggest companies, and the biggest companies finally did really badly. Look, for over a year, we've been talking about how the small cap stocks and the rest of the stock market outside of the FANG M stocks, Facebook, Amazon, Apple, Netflix, NVIDIA, Google, Microsoft, if I didn't say already, NVIDIA, if I didn't say already, well, whatever these stocks do, that's what the market does. But these stocks have been holding up while the rest of the stock market's been deteriorating, so people didn't notice how bad the market was doing because the indexes were holding up. The damage beneath the surface is what I'm talking about. And then I said either those stocks recover the rest of the market, or these top 5 or 6 NASDAQ stocks go down. And what we're seeing now is they're going down, and that's finally dragging the rest of the market, the major average with them. But they're typically the last ones to go down, and they are typically the first ones to recover. So take a cue from those mega cap stocks that they have already, to a great extent, have corrected. All right, so that's one of the things I look at. I thank you for watching. Did I show you this chart? I think I showed you the chart. If I didn't, here it is. And that's it. I'm going to get going. I thank you, and I will see you tomorrow. Have a good night.